How do you build a skew risk premium model? Have you ever wondered how traders analyze options pricing to understand risk better? Today, we are going to break down how to build a skew risk premium model in options trading. This model helps traders manage risk and identify potential returns. Let's get started with the basics. First, we need to understand what skew risk premium is. This term refers to the extra return that investors expect for taking on the risk associated with the asymmetry in asset returns. In options markets, this is often shown through volatility skew or smile. You will notice that implied volatility tends to be higher for out-of-the-money puts compared to calls. This indicates that the market is more concerned about downside risks. Next, gathering relevant market data is essential. Collect high-quality data on option prices across different strike prices and expiration dates for the underlying stock or index. Make sure to include implied volatilities, bid-ask quotes, and the prices of the underlying assets. It is best to focus on European-style options for simplicity. You will also need historical realized volatility and measures of skewness from past asset returns. Now, let's measure implied moments and realized moments. Calculate the implied moments of the return distribution, such as variance and skewness, using option prices. You can use moment swaps or replication strategies for this. Then, compute the realized moments from historical price data of the underlying asset. The skew risk premium is the difference between the implied skewness from options and the realized skewness from historical returns. After that, you can construct a replicating portfolio or trading strategy. Design a dynamic options portfolio that replicates exposure to skew risk. This could involve buying low-strike puts and selling high-strike calls. Make sure to rebalance this portfolio regularly to maintain consistent exposure to skew risk while hedging out other risks like variance risk. It is also important to model the relationship between skew and variance risk. The skew risk premium is closely related to variance risk premium, driven by common factors. You can incorporate this relationship into your model by jointly modeling both premiums. Dynamic hedging is key to isolating the skew risk premium from the variance risk premium. Next, estimate the skew risk premium using empirical methods. This involves calculating the average excess returns from your skew exposure strategy over time. Statistical analysis can show that a significant portion of the volatility skew slope is explained by the skew risk premium. Backtesting your model on historical data is crucial to ensure that the returns are consistent and statistically significant. Finally, consider practical aspects. Account for transaction costs and liquidity constraints when rebalancing your options portfolio. Adjust for-term structure and smile effects in implied volatility for better accuracy. Also, keep in mind that market events and tail risks can impact skewness and risk premiums. Using your skew risk premium model can help you identify mispricings in options, markets, and develop trading strategies to capture this premium. It can also assist in hedging portfolios against skew risk, improving risk-adjusted returns. Integrate this model into your broader volatility and options trading strategies for better outcomes. By following these steps, you can effectively build a skew risk premium model that enhances your trading approach.